Deflation is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And you're not going to believe what Michael Burry says is about to cause a massive deflationary bust. Let's go to Bloomberg, where we picked today's story up with the headline, "The Burry waves off deflation angst," only to backtrack a bit later as he warns of potential price shock. Burry, the investor made famous by Christian Bale in the 2015 movie The Big Short, said that in the late 1970s, rising velocity, the frequency at which money moves through the economy, trumped falling money supply to drive inflation higher and higher. But did he have it completely wrong? Well, I think so. Let's take a look at the money supply, or M2, on a year-over-year rate of change. And I just want to point out that it is massively decelerating here. But back in the 1970s, it was in an accelerating trend. It was rising. Now, it did move up and down, but the broad trend was it was moving higher. Today, it's moving lower. And the question you should ask is, what's driving that? Well, it's the Federal Reserve's quantitative tightening that's dropping the money supply way down. Let's take a look at this next chart and see how that relates to inflation, because here we're going to now overlay the consumer price index in red on a year-over-year rate of change. Now, you might note there's periods here where we see, well, look, the money supply went up and inflation went down. This was due to quantitative easing 1 coming into play, but you can note that there is a relative relationship here. We won't say it's very strong, but notably, when the money supply decelerates, you tend to see inflation either flatten out or trend lower, suggesting that Burry here may be wrong. And now let's look what it means for the stock market, which many people say has a big factor in driving stock prices higher. Here we have the Wilshire 5000 overlaid on a year-over-year rate change. And while we don't see quite the relationship as other factors with the CPI, we can note there are periods where there are sharp declines in the M2 and the market comes down. But we can also note there are sharp periods where the M2 is falling and stock prices go up. So perhaps the deflationary part will only be seen in the stock market as the money supply falls this time, whereas in the past, we may have not always seen it. But let's take a look at the velocity of money, which Burry says will actually keep inflation high. But I want to note that inflation has only ticked up slightly from near historic record low levels. Back in the 70s, not only was the money supply trending higher, but the velocity of money was relatively stable around 1.7 to 1.8. And that was the key that this time we're seeing velocity at a really low level. He thinks it could head higher. But what the factor here, what's going on, what we're missing is that the Fed is driving the money supply down by doing quantitative tightening. They're selling off the bonds in their portfolio. Actually, they're just letting them roll off, and they're returning that money to the banks. They're no longer holding it on their balance sheet. That is, in turn, is causing the banks to either offload that money elsewhere as consumers take their money and invest it, and that's what's driving the money supply down. That is not something we saw during the 1970s because the Fed didn't do quantitative tightening. These comments came after Musk, the world's richest man, earlier this month suggested the Federal Reserve should cut interest rates, warning that a major hike might risk deflation. He was responding to an earlier tweet from Kathy Wood, in which she noticed there was deflation in the pipeline, and well, I think they both got that one spot on. Here we can see in this chart the yield curve, the 10-year Treasury minus the 2-year Treasury yield, that in blue, overlaid against the federal funds rate. And we can note that periods of inversion typically see the Fed cutting. So what Musk is suggesting here is, hey, we're heading on a path that doesn't make a lot of sense. And if there's anything we can show that the yield curve is telling us that the Fed is going to cut rates. How do we know it, you ask? Well, let's just invert the federal funds rate. And here you can see on this chart, all we've done is flip the federal funds rate upside down. And so now it's very clear. Periods of inversion tell us that the Fed is making a huge policy mistake. That's what the bond market's saying. And that's going to lead to yields going down and the Fed cutting rates. Again, shown inverted here. So what we're seeing by this inversion, as Musk is pointing out, is deflationary, because we can tell when we overlay the consumer price index. And here you can see now the yield curve still in blue, overlaid with the consumer price index on a year-over-year rate of change in red. And notably, you see periods of inversion and match a peak in consumer prices. And then as the curve steepens, consumer price index comes down. Here you see inversion, and nope, there's a little transitory increase in consumer prices. Steepening curve, falling consumer prices. Inversion, falling consumer prices. Inversion, transitory increase in consumer prices that come crumbling down. Inversion, small transitory increase in consumer prices, they come down. And here we are again seeing the yield curve inverted, suggesting that the likely path for inflation is to the downside. And if it happens big enough, if the Fed goes too far, we could get an outright deflationary bust. Wood said this week, or also tweeted, that the U.S. Central Bank's rate hikes are, quote, significantly more restrictive than the 1980s. True, when the Fed Chairman Paul Volcker hiked rates as high as 20% to quash price pressures. Current Chair Jerome Powell last month evoked the great inflation of 1979, as he said that period provided lessons on the need to keep at it until the job is done when it comes to taming inflation. And what Powell is suggesting is they're going to keep hiking until they see this lagging indicator of the CPI come down, but the bond market's already telling them it's too late. You're going to make a major reversal. You're making a huge mistake here. But there is one thing that will get the job done and come out ahead of all other strategies, and that's Portfolio Shield. I'll put a link up here in the corner and description below. Let's continue on. Burry did also tweet on the issue of deflation concerns, highlighting the potential that they are having little impact on bond yields because the Fed's decision to trim its balance sheet is more important. And I think what Burry is missing here is the money supply is being decelerated because of the Fed's decision to trim its balance sheet. And one factor that perhaps many people are overlooking that we'll actually see come to fruition is if the Fed drives the money supply negative. That's something that almost never happens since the 1970s, or since, I'm sorry, not 1970s, since the Great Depression when it did go negative. And the last big move in the money supply that went negative was the Great Depression. We see brief moments and a couple of times along the way, but otherwise, that is the deflationary bust, is this negative move in the money supply that's all at the Fed's hands. And now we look at Treasury yields. The 10-year yields rise above 4% to the highest since 2008, which could lead to a massive capitulation by central bankers as the Treasury index is heading for its worst year since the 1970s. And yet intervention may mean Japan sells Treasuries, even though they haven't so far. An index of U.S. sovereign securities extended its worst year since at least the 1970s after St. Louis Fed President James Bullard warned the central bank has to keep raising interest rates to retain credibility, which arguably it doesn't have much of. The U.S. debt also under pressure due to speculation. Sliding yen will compel Japan to conduct more intervention, potentially funded by Treasury sales. And this is an issue, kind of a hot button. And we note that in a conversation yesterday with Michael Gayot on his Twitter Spaces, we talked about this fact that when you see these savings accounts are held by foreign institutions, foreign central banks are in Treasury securities. So when they need dollars, they sell them, but they don't want to. They will do other things, and they will only start selling them when they have to, and by that point they're starting to look at other factors. Perhaps what I've been saying is China perhaps will end up doing a currency deval rather than dumping its treasuries, because it's effectively mutual Armageddon. If they dump their treasury securities and drive interest rates even higher, well, what do you think is going to happen to the U.S. economy? You're right, it's going to head into a depression, and that is not going to lead to more consumption. And here we can see just how much of an impact rising treasury yields are having. Going back to a chart we used yesterday, the current new orders from the Philly Fed Regional Survey. And what I've got is 2-year treasury yields on a year-over-year rate of change. And I kind of want to point out the periods, and it's so hard to see just because of this big spike and rapid spike in yields, that when you see 2-year treasury yields start to trend higher, you see new orders come down. And you do it enough and you enter a recession. You see it happen here, it happened here, you see new orders come down, it happened here and led to a recession. You see this big move up here in 2004 through 2005 actually set the pace for the great financial crisis. You see that downward trend now. We see here in 2015 yields moved up and then new orders started to come down. And look here again, this massive move in yields. Well, the market hasn't absorbed that yet. It doesn't know what that means. And a lot of people don't understand, hey, are these yields going to be a big problem? Well, Jeff Gundlach, the other bond king, says he thinks they might be. That was quick. The national average 30-year mortgage rate posted at 7.08% today in a tweet on September 27th. And for many of you who work or in jobs directly or indirectly tied to the real estate industry, tell me just how well will the real estate market do with yields this high and mortgage rates at that level? Weigh your thoughts in the comments. Do you think we get out of this without another housing crisis? Do you think the mortgage industry is in big trouble? Love to hear what you think, because central bankers now, well, they're starting to panic. The Bank of England steps back into the bond market to restore stability, perhaps as a realization comes in that higher interest rates aren't actually a good thing, as their 30-year yields set for the biggest fall on record after the statement, as officials warned of risk to stability if dysfunction continues, when really they should be warning the risk of a global depression. Let's continue on. With the fall from Prime Minister Truss's tax cuts still ripping through UK asset prices, the central bank had been warned that collateral calls on Wednesday afternoon could force investors to dump government bonds, according to a person on the inside. The plan to buy securities maturing in 20 years or more in daily tranches up to $5 billion or 5.3 US billion had an immediate impact on the gilt market, putting yields on the 30-year debt on track for the biggest drop on record. They earlier climbed to the highest since 1998. The central bank warned that continued dysfunction would threaten financial stability and even damage the economy. It also delayed the start of its plan to start actively selling its existing holdings of bonds, begin to do on Monday. And so all of a sudden, we're starting to see yields fall as the markets start to perhaps anticipate that central bankers are indeed making a mistake, as the yield curve has suggested, because while higher yields will actually deal with demand, they will restrain demand, really high yields will destroy it outright. But again, it happens with a lag. It's not immediate. It will eventually filter its way through the economy, and by that time, it'll be too late for the central bankers to stop. The purchases will be carried out on whatever scale is necessary, suggesting an unlimited purchase of the long gilt. The central bank said in language to doing whatever it takes to save the euro. And now let's weigh in on our thoughts from our chief strategist, Jeff Snyder. He says in his daily report that you can get for only now a couple days left at marketsinsiderpro.com for free before we go paid. He comments on the Richmond Fed's regional survey reported a modest easing in September 2022 district manufacturing purchasing managers indices. The headline returned to zero from -8, and new orders component improved only from -20 to -11, still showing a contraction. But he notes that their average PMI measured recovered only slightly this month, rising from -8.6 to -5.5. More importantly, he says the monthly and regional variation in the new orders worked out to -8.5 compared to -15. He said the growing inventory cycle might be most evident, and how long this negative sentiment, particularly in forward demand order, takes before it becomes more serious and produces a more visible impact in the hard data, eventually including jobs and labor, is a key question markets upsetting global curves. With officials taking a hardline stance of aggressive posturing about inflation rather than prospects for unemployment, this might mean policy won't turn around until that moment when unemployment becomes aggressive. And what Jeff is trying to say here is that continued hiking of rates and tightening monetary policy, as we see new orders collapse, that will lead to a big increase in layoffs. And by that point, again, it'll be far too late for central bankers. The tide will have turned, and the economy for the world will be headed down into a deflationary shock. And with that, I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.